Welcome back, everyone, to my world of stocks, and welcome back to my new monthly update series where I talk about three specific topics. Number one, the current state of the stock market and how I feel about everything that's going on. Number two, what stocks I've bought and sold over the past month. And number three, what stocks I'm interested in buying next month, which of course will be June 2020. And if you guys want to jump to a specific part of the video, I'll leave some timestamps for you down below. All I ask is that you please hit the like button in return if you like the video, as it really helps the channel. But with all that said, let's go ahead and start with part one, which is the current state of the stock market and how I feel about it. And as you might expect, I'm not too happy with the current state of the market. As you guys know, I am someone who likes to do the majority of my buying when stocks are going down, when the overall market is going down, as it gives me the lowest prices possible on some future long-term investments. But of course, lately we've had the exact opposite of that, as the Dow Jones was actually up slightly in May, despite having already climbed by over 11% the month prior, leaving it currently up by almost 35% from those lows that we hit back in March, and only down less than 15% year to date so far in 2020. Now, in most other circumstances, the market being down by almost 15% year to date would translate to a great buying opportunity for me, but of course, what we're seeing in the economy right now is anything but typical. In fact, many would argue that we are on the brink of a depression-like economy, with April seeing the largest increase in unemployment in a single month's history, bringing our total up to almost 15%, which is also a historic record ever since the metric has been officially tracked by the government starting in 1948. For context, the Great Depression was estimated to have unemployment at around 25%, and of course, many economists are still predicting that we could easily be headed to those levels when accounting for misclassifications, and especially if the economy continues to deteriorate like we've been seeing as a result of not opening the economy back up, which continues to be a very controversial and hotly debated topic these days. And the reason this worries me, as someone who is typically a net buyer of stocks almost every single year as more of a long-term minded investor, is because we're essentially dealing with a propped up stock market that clearly shouldn't be trading at these higher levels. Even on a trailing P basis, the S&P 500 is sitting north of 20, which is way too high for what we're seeing in the economy going forward. Keep in mind that a trailing PE uses the past 4 quarters, which still had decent earnings overall. It's really Q2 and Q3 that I think will have the worst reported numbers, but those are not really factored in yet. And for context, the market average is usually around 15. So I just think sitting at north of 20 is a bit too high right now. And obviously we would be much lower to those levels if the stock market hadn't shot up like a rocket ship ever since the end of March, which obviously was in large part due to all of the government and Fed intervention, which the markets loved. And again, don't get me wrong, it's fine if it keeps our economy from completely collapsing and also helps us bridge over to next year, where I think we could start to see a decent sized recovery. But the end result is that we just don't have a lot of good deals in the market right now, unless you're willing to buy the really badly beaten down sectors, like maybe finance, with this bank ETF down almost 40% year to date, because banks, of course, do very bad in destroyed economies. Travel, with this airline ETF down over 50% because of no travel demand right now and the fear that it will be slow to ramp up again as the airlines take on gigantic amounts of debt on huge losses every month. Or even specific areas of retail that have had to deal with lockdown orders, like Nordstrom, for example, down over 60%, with many of those already being completely disrupted by the rise of online shopping, as well as entertainment companies like AMC down over 30%, hotels and casinos like Wynn Resorts down over 40%, or even theme parks like Six Flags down about 50%, all having to deal with similar issues as the other sectors: lockdown orders, limited capacity, low demand, and a horrible economy that means less consumer spending in those areas, resulting in big losses and again increased debt going forward. So not exactly a value investor's dream paradise here, even in those heavily beaten down sectors. And even for more growth oriented investors like myself, there's really not a lot of growth to be had out there in this type of economy, and a lot of these companies are also dealing with a lot of added risk as well. So this market overall just isn't that attractive, in my opinion, for almost any type of investor unless you're willing to take on some of that newly added risk. And so the reality of the situation is that in this type of market environment, I just don't think you're going to be finding those great prices or those deep discounts on the great companies like the Amazons and the Microsofts and the Googles and the Facebooks, companies that have amazing balance sheets and still have relatively strong performance even during this horrible crisis that we're going through. Those companies are going to be the most sought after stocks out there. And so they're going to be trading for a premium. So even though those are the stocks that I would like to have, those are the ones that I don't really expect to be trading on sale. And I'm still kind of trying to come to grips with that in this type of market environment. Now, don't get me wrong, I am someone who is more optimistic than most. I do also think that the market is up right now because it tries to be forward looking, and I am optimistic about that future. But overall, I find myself in this type of market just trying to find stocks that are a little bit more in the middle of those kind of two extremes. Being more strategic with this, looking for stocks that still are still trading at a decent value, but don't have overwhelmingly high risk or completely destroyed businesses. And so, with that said, what stocks have I been buying and selling over the past month or so? Let's go ahead and talk about that now, and then we'll transition over to finishing up the video with what I'm looking to buy heading into next month. Okay, so like I mentioned in last month's video, I was looking to add a little bit to my high yield dividend stocks that were still reasonably priced in my opinion, and that's exactly what I did with the telecom giant AT&T and the mask maker 3M. Of course, I already own both of those stocks, but with my AT&T position, I added a little bit more at around 28 bucks a share, giving me a huge yield of almost 7.4%. It's a very nice yield. And while I am worried about them cutting that dividend because of the economy putting pressure on their advertising sales, along with their horrible balance sheet that carries gigantic debt, they did at least recently say that they are generating enough cash flow to continue paying down that debt and still have enough left over to continue paying the dividend while also continuing to invest in fiber, which is very important for the future of internet usage, 5G, which is very important for the future of cell phone usage, and also HBO Max, which is again, very important for the future of video streaming. And while I'm personally not that excited for HBO Max myself, as I'm just personally not a big fan of their lineup, I'm just hoping that it helps offset some of their losses in cable TV subscribers. By the way, I don't know how many of you are familiar with this, but the Zack Snyder kind of director's cut for Justice League is something that a lot of people have been begging for. It kind of went viral online. It's a long story. I don't really want to get into it, but it looks like that will be offered exclusively on the service, which is kind of cool. So hopefully that does boost numbers as well. But that's something that a lot of people were just like demanding to get the director's cut of that Justice League movie. I'm not really a big fan of the direction that all of DC has been kind of going over the years, but hopefully they turn that around. Anyway, the stock is still at some of its lowest levels in years, and I'm generally comfortable buying in the $20 range. So with a yield of about 7% still and a dividend growth history of over 3 decades in a row, I may continue to add in small amounts as long as it stays at or below these levels. And then the other dividend stock I added to was 3M in the $130 range, and at that price I was able to get about a 4.3% dividend yield. And I don't want to spend too much time talking about this one as I've already done so extensively in the past, but what I like about them is that they have the biggest dividend growth history of all my stocks in my portfolio at over 6 decades in a row. And just like AT&T, the stock is also trading at some of its lowest levels in years, although I prefer it in the $130 range. So I may wait to see if it dips a little next month before adding any more, since I don't want to be too heavily reliant on it given their poor balance sheet with over $20 billion of long-term debt and heavy exposure to the macroeconomy that can hurt their business. I do, however, think that their safety business will be in high demand right now during the global health issue, so that should help them weather the storm and continue paying the dividend, which I am very happy to continue collecting. Now, there is, however, one other stock that I purchased a little bit more of recently, and it was a very tiny amount because I already have a fairly large position in it, but that was JP Morgan Chase, the big bank. And look, I'm not going to sugarcoat it. Bank stocks are extremely risky right now because of the weak economy resulting in more people unemployed, both them and businesses possibly defaulting on loans, and also less spending on big purchases that might use bank loans, so less demand as well, resulting in less revenue for banks with higher losses, and of course, a 0% interest rate environment that only hurts margins even more and destroys profitability. So just really, really difficult times. But during normal times, JP Morgan has consistently proven to be one of the best, if not the best, run bank out there, and an extremely profitable one too, doing over $36 billion of net income last year alone, which allows them to pay some very nice dividends. Now, I purchased a few shares this month in the low $80 range, and I'd much rather get it in the 70s if possible, but even here, I was able to get a dividend yield of over 4.2%, which is pretty attractive. Of course, the fear is that they will need to cut that dividend, here in the future, given the weak environment, which, by the way, they've already said that they are willing to do so if the economy continues to worsen. But over the long term, it's still a stock that I would like to hold in my portfolio for diversification purposes and for dividends in the future, even if they have to kind of cut it and then ramp it back up. Now, meanwhile, the stock trades at some pretty low levels compared to prior years, currently down over 35% year to date, and I just really can't see a scenario where America's largest bank goes out of business anytime soon, so I'm willing to hold it long term and maybe add some more if it dips more heavily from here. And finally, just to finish up this section with any stocks that I sold recently, I did trim around half of my Carnival position, which I had split into two accounts, one on my E-Trade and then a larger position in my Robinhood, and I ended up selling out completely from my larger Robinhood position. And as I showed you guys in previous videos, my Robinhood position had a cost basis of about $11.90, and at the end of April, I sold out of that position entirely at over $16 a share, so very nice profit there. And then I just kept my E-Trade position that has an even lower cost basis of less than $9 a share, so very low there. And the reason I did this is because I consider Carnival to still be very speculative right now, and I just wanted to lock in some profits here while also lowering my exposure to it, going from over 2% of my portfolio down to about half of that. So very tiny position, don't have to lose any sleep over it or anything like that. And of course, the issues right now with Carnival are that, of course, they're not sailing yet, and that's resulted in billions of dollars having to be raised in junk bonds just to survive the rest of the year with virtually no revenue coming in. I do, however, think that they will survive this and eventually see some recovery once a V-shot is made widely available and people feel safe to travel again, which optimism over that and their low share price has attracted some large purchases from Saudi Arabia and even insiders, but both are prices much lower than where the stock is trading today after seeing a big bounce from the bottom with that insider purchase at just $8 a share, yet the stock currently trades close to double that amount at 14, but is still down over 70% this year alone. So I guess you could kind of look at it in a couple of different ways. Given that they are the largest cruise line in the world though, and that I think cruises will eventually come back, I am willing to hold my reduced position for now and see if I can make some more profit on it over the next few years. But that was most of my activity over the past month or so. Let's now talk about what I am planning to buy heading into next month. And I think you guys are going to be surprised by some of the stocks on this list, and some of you might even get angry with me on these choices, but I'll do my best to defend my reasoning for some of these. Okay, so there's three kind of groups of stocks that I'll be looking for next month. And the first one is kind of an obvious one, and that is if the stock market was to struggle, if we see a decent sized correction or a big dip and it kind of pulls everything down with it, then of course I would be looking to add to my favorite foundational stocks, those great companies out there like Amazon, Microsoft, Visa, those kind of stocks I would be looking to add. I would also like to pick up new positions in some stocks like Google or Facebook. Those would be absolutely great buys if I was able to get them at a discount. However, I don't think that that scenario is the more likely one. I think the more likely scenario is where the stock market just kind of trades sideways here because of how much intervention is being done by the government and the Fed. And in that scenario, I would have to be a little bit more strategic, and I would have to look for, again, companies that are kind of in the middle of those two extremes, stocks that are trading for reasonable prices and are not overly risky, not too much risk, not to the point where their businesses are completely shattered and destroyed. And so that would be stocks like I've been buying, kind of like AT&T or 3M, that also pay some really nice dividends. But maybe making some strategic moves for some other different new, maybe some new stocks as well. I'd have to kind of play it by ear and do some research as we progress through the next month. But then there's a third group here and kind of a third scenario. And this one might upset some of you. And that's because this would be stocks from the country that kind of caused this whole global issue. I'm just going to refer to it as the C country, using its initial because of YouTube rules that I'm not a big fan of. But I just think that C stocks have a decent shot of seeing some dips here over the next month, which may present some attractive buying opportunities for me. And I'll explain why in just a second. But first, let me just defend myself by saying here that I'm not someone who is happy with the C country's government or the way that they've been handling anything. In fact, I'm very critical of them on a personal level. But I don't know enough about C companies to say that they are at fault for the same things that the C government has been doing. And so when I own C stocks, I just think of it as owning those companies. I don't imagine myself owning the C government. And I know that you could argue that, it is kind of part of it because of the communist government and the way that they're all set up, but that's just not really how I look at it. It's just my personal opinion, my personal feelings. I don't know enough about these companies to really judge them to that extent. So I will continue to hold my investments in those stocks. I don't think it's good enough reason to force me to sell those stocks. But my opinion could change. And I'm definitely not saying that I'm right or that I'm wrong. It's just my personal opinion. And of course, I support your opinion, even if you completely disagree with me, and I would love for you to share your thoughts down below, and I will definitely consider your point of view, and I'll take it into account, and who knows, maybe you actually change my mind. We'll see, but as of right now, that's just my personal opinion on that. I'm still willing to invest in those type of stocks if I think there's an opportunity for me to be able to make some money in the stock market with those investments. Okay, so having gotten that out of the way, let's now run through the reasons why I think that we could be seeing C stocks head lower and which ones I might be interested in buying over the next month or so. Well, like I said, the country's government is to blame for a lot of the world's problems right now, and because of that, Trump has ordered the Federal Pension Fund to remove its plan for investing several $billions in C stocks. Now, that alone at around $4 billion isn't enough to crash their stocks, but it could lead to further action in the future, and that uncertainty could cause some dips. In fact, the National Economic Council chairman Larry Kudlow talked about the possibility of future sanctions resulting from the actions of the C government and how they handled the global spread of the global health issue. However, it looks like the board actually rejected Trump's request and are now expected to continue with the plan to invest the over $4 billion. But something to note here, those board members, they serve on expiring positions that are actually appointed by the president, who just so happened to nominate 3 new appointees, which I believe would give him majority control since the board only has 5 members to begin with. So it's very possible that we could see some big changes here coming soon. Meanwhile, Kudlow also added that those stocks are risky for investors since they don't have to comply with certain rules. Well, it just so happens that the Senate has now voted in favor of passing a bill that will force foreign companies to allow American regulators to access their books and ensure all of their accounting is honest and accurate, which, by the way, is the same standard that we use for American companies. And I really think that that's a great move, and it's something that we should have passed a long time ago. But all of this attention is likely not wanted by the C country. In fact, the SPDR S&P ETF for the country fell by over 2% on Thursday and over 3% on Friday following the news. And if all of this drags C stocks down over the next month or so, there's 3 primary ones that I'll be considering or I'll be looking to pick up. Now, the first is obvious as I already own a large position in it, and that's the C e-commerce giant Alibaba, which fell about 6% on Friday, but is still trading near record highs. So I'd like to get a bigger dip if possible, but having by far the most e-commerce market share coupled with the most cloud computing market share in the country and very strong financials with huge growth for its size, especially on the top line, and plenty of future potential, it makes this an obvious choice for me to pick up on any significant dips. Now, the second one is another pretty obvious one because I also own a large position in it, but it is a newer position in my portfolio than Alibaba and a little bit smaller too. And that's the internet tech giant conglomerate known as Tencent, which is of course known for having some of the largest social media apps in the world, including the #1 messenger app in the C country with WeChat. And they're also the largest video game company, not just in the C country, but also in the entire world. And just like Alibaba, they are a dominant player in cloud computing with the second largest market share in the country and even higher growth. Also, like Alibaba though, the stock is trading near some of its highest levels despite falling by close to 5% on Friday. But give me another dip on Tencent and I will definitely be a buyer, as I just see it as a very solid and reliable play on the future of internet technologies in that country, social media, gaming, AI, and cloud computing, with very nice revenue growth over the years that have generated solid profits as well. Speaking of which, my third stock that I'm interested in is the fourth largest cloud platform in China, only behind the first two, as well as Amazon, and it actually has higher growth than all of them in the country, and that is of course Baidu, which is actually a stock that I have never owned myself, but have always watched it very closely, waiting for the right opportunity. Now, I wish I would have bought them at the 52-week low. It was in the $80 range. That seemed like a great price to me, but I might be willing to settle for around $95 or less if I can get it. And of course, just by looking at the stock chart, you can see that it is the exact opposite of Alibaba and Tencent, as it is actually down almost 50% over the past 5 years. And that's due to several different reasons, including their large investments in high growth platforms like IQ, which is known for being the sort of Netflix of the C country. And that's hurt their profitability as they subsidize their losses for them. And of course, the weakening C economy has also crushed advertising spend, which is something that Baidu heavily relies on, as they are considered the sort of Google of the C country, with by far the most search market share in the country at over 65%. And of course, just like Google, that brings in tons of advertising revenue along with their other platforms. But also like Google, Baidu is a huge play on the future of artificial intelligence, as last year they were the only C company to be listed among the top 30 AI patent applicants in the world by the World Intellectual Property Organization, and they even do autonomous driving with their Apollo platform that is aiming to offer a robotaxi service just like Waymo, which they actually already launched a trial version of last month. But as I mentioned, they definitely have their issues, and that's led to very little revenue growth last year and a big crash in profits to go along with it, all of which will likely take another year or two to recover, since the macroeconomy in that country has been so heavily destroyed by the global health issue, and just kind of the global macroeconomy has also been struggling as well while we're on the subject. Okay, so I think that just about does it for today's video. Let me know what you guys think down below about all the things we talked about in the various stocks that we discussed. And let me know if you're interested in buying any kind of stocks heading into the next month, what those stocks are, and if you have any predictions about where the market is headed. I would love to hear those thoughts. I will try to respond to as many comments as I can. And of course, if you enjoyed the video, please consider hitting that like button. It really helps a lot, and subscribe if you haven't already. But thank you for all the support, guys. I hope you're all doing well out there, both health-wise and financially, and I'll catch you in the next one. Take care. Bye-bye.